Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Beth Underhill. She's been active in construction and real estate for over 20 years. Beth has redeveloped over $5 million in single-family homes and assisted in constructing over $35 million of outdoor living spaces, while also being a co-GP on over 500 multifamily units and 486 student housing beds. So thank you so much for being on the show today, Beth.
Absolutely. I'm excited to be here. Thanks for having me.
So before investing in real estate, if you can tell us a little bit about yourself, both personally and professionally. I read somewhere that you'd been an entrepreneur for over 25 years. Is that correct?
That is correct. Yes. I want to say that my start really came from actually having a W-2 job. I was in my early 20s, I was hired on as the director of catering for a small boutique hotel in Findlay, Ohio. And the general manager really gave me free rein to run the department as I saw fit. It was operating in the red prior to my arrival, so I was tasked with turning the department around, which came with, obviously a number of issues, including firing people that were older than me. So that was an interesting experience, to say the least. But the fact that he left me alone to run the department really gave me a taste of, oh, this is what it's like to run my own business and to be in charge and to just, make all the decisions and be responsible for the outcomes associated with those decisions. And so, shortly, I was there for about 5 years, and then the boutique hotel was sold to Marriott. So I knew that with Marriott coming in, obviously things were going to be run a bit different, and I would not be able to operate in the same capacity. So I elected to leave the hotel, and I moved to Cincinnati, of which then I found a W-2 job at a catering facility and quickly realized that I just did not work well underneath people. And so I needed to go out and kind of pave my own way. So the first thing I did was actually I became an insurance agent. And really with an insurance agent, I was working for a general agency, but essentially you are also your own boss. You're creating your own business, your own book of business. And so that was my first kind of endeavor into the world of entrepreneurship. And then I met my husband. And shortly after I met my husband, we started what is now the current business that we have, which is an outdoor construction company. We build outdoor living spaces here in Cincinnati, Ohio. It originally started as a landscaping business, but it morphed into this outdoor construction business as a result of the demand for for our clients wanting these beautiful spaces where they can hang out outside with pools and patios and fireplaces with flat screen TVs and outdoor kitchens and so forth, which of course they became hugely popular during COVID. And that I'll get to a little bit later. But yes, during that time of us having this business, which we still have it today, I also had a catering business, which, my love for cooking comes from my Italian background. And then my daughter was born, and I thought to myself, the catering is so heavily dependent on weekends and nights and so forth. And so I wanted to, really just put more effort into my family. And so then I started an internet-based business out of our home, and it was for women's golf apparel and accessories, which of course another love of mine, which is golf. And then actually that was an interesting journey. Just like CVS and Walgreens are on, corners competing, I had competition online, and one particular competitor thought that I was too much competition for her. So she attempted to go to mutual vendors to try and get them to stop doing business with my company. And we hadn't been in business quite as long as what she had been, but we were definitely taking a piece of the pie from her. And so as a result, I ended up in a lawsuit against her for tortious interference with business relations, won a small settlement, and I kind of thought to myself, you know what, I think this is God's way of saying, I'm not supposed to be doing this anymore. So then I went on to a fitness studio, which I had for 7 years until I was diagnosed with cancer, and that prompted me to end the brick and mortar business And I pivoted then into real estate. So that's my husband and I, we started fixing and flipping single family homes. But once COVID hit, of course, our outdoor living space construction company went crazy. And as a result, we had to make a choice. Do we continue to try and do both, or do we give up the flipping and I pivot within the real estate space to something else, which is when I pivoted into commercial real estate and syndications.
Interesting. Very interesting. Why, obviously you were already involved with real estate at one level as being a contractor and in construction. Why did you choose real estate as an investment vehicle? Because you'll usually find people that are one or the other. There's some people that are both, right? But when you talk to some contractors, they don't own any real estate, and you talk to real estate investors and they're not contractors. So why did you choose that as your investment vehicle when you're making that decision to get out of that previous business?
Yeah, absolutely. For us, it was really just about building generational wealth. So when, in thinking long term, knowing that, we went through some tough times with the construction business, especially with the labor force. They're electricians, plumbers, carpenters, good ones are hard to come by. We're starting to see, however, that, there has been more of a push, especially for the younger generation, realizing that AI might take tech jobs away from them. So they're opting to look at trade schools and the trades as an option, realizing that they can build, a nice business being in the trades. For us, it's when we started to see that trend of struggling to find just good, solid, contractors, subcontractors, and so forth. That's when we really took a hard look at, what does our future look like and how are we going to paint the picture for ourselves in terms of, 5 years, 10 years from now, still be able to earn income, but do so just in a different manner. And so that's where, syndications became part of it. And then, just some other things that I've now branched out to beyond syndications within the real estate space.
Nice, nice. So can you explain what your current company's kind of investment strategy and criteria, what you guys are looking for properties in your syndication business?
Sure. So we actually are focused on the student housing niche, which, is one of those niches that not a lot of people want to travel down that path, but we love that path. And one reason being is that we have a partner who worked for Landmark and Dovetail, which are two of the largest student housing, property management, and development companies in the country. And so he brings a wealth of knowledge, a wealth of resources, broker relationships and so forth. As we call it, he knows where all the bodies are buried in a lot of the markets, right? So he can tell us like what's happening in these markets and what we can expect and which markets we should go after and whatnot. But we love the student housing space and for a multitude of reasons. I mean, number one, the students sign 12-month leases, and most people are under the impression that it's just for 9 months or the academic year that they're signing leases, but that's really not the case. And mom and dad are backing those leases or some guarantor. So if something happens with those leases, we know that somehow, some way, they are going to get paid. Unlike with traditional multifamily, you might be chasing after, people who are not paying their leases. Maybe they lose their jobs and they don't have any sort of backup system and whatnot. The other thing too, our leases they all start right around the same time and they end around the same time. So what does that mean? It means that somewhere around, I'm going to say middle of August to end of August, we know exactly how much revenue is coming our way, in terms of on a monthly basis. So it's a very, nice thing to know, like, hey, here's our income and we don't have to worry about, the fluctuation that may occur with respect to if, 10 leases come due in November and now we need to replace those 10 leases and we can only replace them with 5. That means that our revenue is going to be lower than expected. We know exactly how much every single month that we're looking at.
So a couple different things on that. As I found out when renting to student or college students in a very, very small level, when I started decades back as a multifamily investor, I found out that, they usually are staying for 1 year, sometimes 2 years. Is that correct? In like so when you're doing the make ready, if someone's August to August, if they're looking to rent that, they're signing leases in June for someone because you already know that someone's moving out, or maybe they're signing it in July, whatever it might be, for moving in August. How is that make ready between your tenants? Do you have, so there's a window there, you know what I mean? Because like with multifamily, it takes a couple of weeks. It's prepared depending on what kind of work is done, maybe 1 week, and then we put it back out on the market. How does that work with the turnover on, with student housing?
Sure. So we've got a window of about 3 to 4 weeks. So somewhere between mid-July and mid-August, and we call this, and it's called actually in the student housing space. It's not a name or a word that we coined, but it's called term. And so during that period of time, it's a very stressful time for property management companies, truth be told. But, they have prepped in order to be ready and prepared for it. So they have walked all the units. They have made their lists of, okay, here's all the furniture we're going to need to replace. Here's, where we're going to need to paint. And so they have everything lined up so that within that, 4-week window, everything's taken care of. Now, the beautiful thing is that a lot of times you have renewals, right? So as you mentioned, students generally are going to be living off campus their junior and senior year. Sometimes it'll be sophomore year, and even as of late with some universities, it's actually freshman year. And we can talk more on that, but at least they're there for a couple of years. And as a result, you don't have to turn as many units as you might think. So for instance, if you had a 100-bed asset and you've got a 50% renewal rate, well, guess what? You're only worrying about those 50 beds, which could ultimately mean 25 units that, might need paint or furniture or, anything, whatever. So it's not as overwhelming as one might think. Now, when you get into those larger properties where you might have 500 to 1,000 beds, that can be a little bit more daunting, but we typically stay away from properties of that size.
So what is the strategy, the value add strategy with this? How do you do new deals? Are we building these properties? Are you're taking a apartment complex and turning it into student housing, like some sort of conversion? I say it's because my brother-in-law works for a large contractor, and they just finished a project at Gainesville, University of Florida, and they were building student housing. And what they were saying is that every unit was made perfectly for student. They made it specifically for this as apartments with like 3 or 4 bedrooms, common kitchens, but like in-suite bathrooms, the whole 9 yards of how they do it. And like how that's done, it makes perfect sense. And then they sell it off to like a syndicator, or the owner does, the developer sells it off. So how does your value add work on that? Of like, is it only new development, or are you also doing conversions?
So we aren't doing any conversions because generally speaking, the conversions are not purpose built, right? They're more apartments, so they could be a 1-bedroom, 1-bath. They could be a 2-bedroom, 1-bath. You can charge, of course, with the 2-bedroom, 1-bath. Something you can charge per bed with that in that particular scenario. But no, like what we are seeing, especially with the purpose-built student housing properties, is exactly what you just described. 2, 3, 4, 5 units, all the way up to 6 units. We have a property actually where they're cottage homes. So each cottage home, 2-story, and there's a bedroom with an ensuite, and then main floor that has a kitchen, living room, washer and dryer, and so forth. And then up top, there's however many bedrooms, or there could be if it's a 6-bedroom unit, there could be 2 bedrooms on the first floor, but that's what we're seeing. And these purpose-built student housing properties, what we love is we go after the Class A properties, or a developer who maybe has held on to the property for a year or two and then wants to sell it. Reason being, a developer doesn't want to be in the student housing space. They don't want to be managing student housing properties. So what they do typically is they will lease it up, but they're not going to push the leases to market rent. Why? Because they need to lease it up to look good for the bank. So the bank wants to see it completely leased up, cash flowing, like, hey, you've done your job and so forth, and we can still be supporting this loan. And that's where we come in, because we want to then come in, take it over, know that there's still meat on the bone, and be able to push those rents and create the operational efficiencies in a particular market, if we can scale and get 2 or 3 properties in that area. So that's what we look for. So out of all our properties currently, one was purchased directly from, no, 2 directly from a developer. One, we were kind of the middleman between, there was a developer, then an owner, and then we purchased it, but still a Class A property. And then we just purchased another one, smaller, but it's in the same market as one of our others. And we like this particular opportunity because it offers a lower price point relative to our other property in that area. So we can kind of go back and forth with, students that are looking, and we can offer them, 2 different options based off of their budget.
Interesting. Yeah, no, that's a great explanation. Thank you. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. One thing that I like to ask in real estate investors, because all asset classes are similar, especially like student housing, multifamily, it's very similar. When a new deal or a potential deal crosses your desk, what does like the first 10 to 15 minutes of that deal consist of for deal review for you? What are you looking for? What are things that move it to the next level? And what are things that kind of get it X right there?
Sure. So a couple things. Number one, what's happening with the university? Is the enrollment growth, trending so that it's going up? Have there been, any sort of dips in enrollment? And if so, why? What's the academic program look like? What does the athletic program look like? You'd be surprised at how much an athletic program plays into where students want to go. Like, I'm in Ohio, right? So kids go to Ohio State because they want to be a Buckeye. They want to be part of the experience that comes along with Ohio State football. We have a property at the University of Georgia, and Georgia is doing, of course, for the last 4 or 5 years, Georgia's been doing fantastic with respect to football. So you have a lot of kids that are within Georgia itself that are going to UGA specifically because of that. So of course we want to see all of those things. In addition, we want to know that the market's not saturated, that there's, this absorption and that we can maintain, something close to 100% occupancy. In several of the markets that we're in, there's a moratorium on any additional student housing off campus being built. So that's a plus for us, right? That just means that, hey, we're pretty much guaranteed that, our property is going to be anywhere from 98 to 100% leased out. And that's what, that's what we want to see. That's what our investors want to see. Obviously we have, fiduciary responsibility to them. So it's important, for those sort of things. So yeah, a multitude of things that we look at, but those are some of the ones like right off the bat. And typically too, we want to be in places that the weather, I don't want to be in Minnesota. Nothing against Minnesota, but you know what? Snow and so forth, it's not going to be as big of a driving factor as, something that's in the Southeast, for instance.
Right. So you mentioned prior that, you have a great partner that you've been working with, and syndications are really all about partnering. The general partners partner with each other to operate deals. and past investors partner with those same operators to invest in those general partners. So how do you? It really comes down to vetting partners, and how do you vet an operator to find one that you can trust, that's going to get the deal done, and all these different factors that you're because you're leaving everything really in their hands, in their lap.
Yeah, I mean, that's a great question. People have, obviously investors have vetted, our, us as operators. I mean, I'm on a team of six. There's six of us that operate these student housing properties. So people are vetting us, through social media, for instance, checking us out online, LinkedIn, Instagram, Facebook, and so forth. I think, track record is one of the things that I know I stress with investors when they are looking at us, or if they're looking at other operators. What has been the track record? What have these operators, gone full cycle on? And can you talk to any of those investors that have been part of those full cycle deals? Are they willing to share, refer you to someone that you can speak to get a sense of, what were their communication styles like? How often did they communicate? Were they, transparent? If there was anything with the property that was going awry. So I think those are all very important. Sometimes people even have suggested, do background checks. I've never had a background check done on me. But I do know of people that have done background checks on operators. It's real important. I mean, integrity, your name, it's everything in this business. We've seen, and I know you've probably seen, operators that have, started off, really strong in 2020, 21, and now they're out of business. And primarily because they were too aggressive in their underwriting, maybe just didn't know how to manage the asset. That's what we feel very blessed about. Asset management really can make or break an investment opportunity. And I think asset management is one of those areas that is really not looked at as hard as it should be, or, even in, when you do or take a master class, or you are getting educated, asset management isn't what most people educate on. It's typically, developing broker relationships, finding the deals, underwriting, raising capital. But asset management to me is like, if you can't execute the business plan that you've laid out for your investors, then guess what? They're not going to get the returns that they were anticipating. And that, can really make or break whether investors come back to you or not.
Yeah, one other thing to add to that list of what new syndicators made mistakes was buying poor locations or less than ideal locations. Let's just leave it like that. And that's the syndicators that I speak to that had issues that are having workouts done with banks. They had better locations. The ones that you read about on these, different publications that we all check out, that went right under those. If you pull up the location of them, you're like, okay, now I see, investor, somebody came back and they're like, this is, decades we're going to be holding this thing for. So we just got to cut it now. Whereas another one, you're like, we're going to start getting rent growth in the next 24 months. You know what I mean? We can hold on and not lose money or whatever, or lose less or whatever it might be.
Right. And that's one of the reasons why, honestly, like for student housing, location is a bit easier to determine. If a university is a strong university consistently year over year, it's easy to decide, okay, hey, we should be looking. And if we happen to come across something that's, off market, then great, we should go for it. Whereas, location for multifamily, can vary, and, a market might be emerging, but it could stall out for a variety of reasons. So yeah, location, that's what they say.
And it's true. One of the questions that I had, because, adding on to what we were talking about with syndicators going through tough areas, is just sometimes to avoid a property going under, you'll find some of the investors that might do like a capital call. And, can you explain a little bit about, because I think this is not something that's really discussed with syndicators. We're talking, it's sold as the passive income and there's no issues and stuff like this. But once in a while, and I've been We've never put out a capital call ourselves, but like I've received capital calls and I've paid them as a passive investor in deals. Can you explain a little bit of what a capital call is and kind of how it works to inform a possible passive investor of what could happen?
Sure. I mean, to be honest with you, I've not been involved in a capital call, so I may not be the best person to explain it. But my understanding is that, it's a situation in which, the property is not performing as it should be. And as a result, there needs to be a capital infusion by the partners, essentially, both on the GP and the LP side. I mean, a lot of times, you'll see the GP come forth first, if there's more capital that needs to be infused. But if that doesn't solve the issue, then, LPs or the limited partner investors who are, assuming that this is all passive and they don't have to worry about, all of the headaches that come along with managing a property, then they will have to then, put money into the deal. If they choose not to, then their shares are essentially diluted. As a result, if they put money into it, then their shares either remain or however, it all works out based off of, how many investors put money into it. I think, for capital calls, what I know of and what I have heard is, you're more likely to get your investor to put more money into it as long as you've been transparent about what's been going on with the property. I think when it comes as a surprise, which I have heard, some investors have been like, I was totally blindsided. We knew nothing about it. When they're more blindsided, they feel like they've been duped, and so the trust is not there anymore versus, maybe you have a situation where you hire a property management company. You think that this is the right property management company. They end up not being the right property management company. So you have to bring somebody else in. And as a result, maybe there's more capital that needs to be infused into it. And I'm just, creating a scenario here, but, sometimes there's situations that are beyond, control. And I think when the operators are forthright about what's going on with the property, there is a higher likelihood of investors then putting money into that deal, because ultimately what? They don't want to lose money. They don't want to see the property go back to the bank. They know that they are lower on the totem pole. The debt is always going to get taken care of first. Equity will get taken care of last. So if investors expect to see their money come back to them, then they're more apt to put that money into it. But I think transparency is key.
Yeah, no, that's a great explanation. Thank you. The one thing you were talking about with transparency, I mean, you've built a investor base of hundreds and hundreds of investors. I mean, how important has transparent communication been in growing and maintaining your investor base? Because every deal is a little different, and not everything is obviously going to go to pro forma. It's going to be above and below. I mean, how has being proactive with just being open and with the communication lines with your investors kind of helped you grow and also maintain your current investor base?
You know what? It has been critical. The communication critical in, we went through a bit of a tough spot just recently, as a matter of fact, with one of our properties and the investors associated with that property. We have a JV equity partner that's part of one of our deals. And so everything has to pass through the JV equity partner for approval before we can distribute K1s or before we can even make distributions. And so as a result, this JV equity partner, they have a process. So we had, K1s that weren't, being delivered in as timely of a manner, primarily because we weren't really aware of how long this process was going to take with the JV equity partner. So it went on much longer than we anticipated. And as a result, and by no fault of theirs, right? I mean, they have a process. We need to respect and abide by that. That's, according to the agreement. And so it was on us to actually be more aware of, hey, if this is the process, then here is when we need to make sure that we are starting our own process in order to deliver timely K1s. So we did have some fired up investors, but there was constant communication. And we finally got to a point where we said, hey, investors, we're holding a Zoom call. Like, for anybody that wants to know what is going on with these K1s, we will be completely transparent. You can ask whatever questions you need to. And it's always interesting, right? Because investors will reach out And sometimes their bark is worse than their bite, right? And if you just talk to them, if you just explain what's going on, 9 times out of 10 they're going to be fine. But we held this Zoom call, and we didn't have as many investors as we anticipated based off of the number of investors that were reaching out to us. But the investors that we did have, we're all very like, hey, thank you. Like, this really helps me. Like, what can we expect going forward? So we were able to ease their mind. And so I think that was a bit of a lesson learned for us, especially when you have a JV equity partner that's part of a deal and does control, some of the narrative in terms of, how things operate. So, lesson learned for us, but it turned out fine. And we're already starting to work on K1s now, so we don't have that same experience next year. And I was the one that had to deal with, the brunt of it, which was fine. So I had a period of time that I was like, wow, I can't wait to get to the end of this. September 15th could not come quick enough. But we made it through. I made it through. I'm here today, so it's all good.
No, it's great to hear we're working through problems. But yeah, the communication, every time the lines stay open for communication and you can kind of put investors at ease and so they know exactly what's happening, it makes everything much easier. And it's a tough conversation, but usually when you're doing it, it's not as tough as you thought. So it's just easier just to, allow people to reach out, and doing the Zoom call is a great way of doing it as well. So we've done that before as well when updates on certain properties. As we're kind of finishing up here, just as being 20 plus years in construction and real estate, I mean, what are common mistakes you see real estate investors make?
Common mistakes, I think, jumping in without really knowing what it is that they're after. So for instance, my husband and I, when we started fixing and flipping single family homes in 2018, we did so based off of Chip and Joanna Gaines, HGTV, Love It or List It. We are at, we're relaxing in the evening, we're watching these transformations, and we're thinking to ourselves, we can do this, but what we didn't really take into consideration was how that was going to impact our current book of business for our construction company. And in addition to, what does this look like for our future? Does this build equity? Yes, it puts cash in our pocket, but if we don't do something smart with that cash in our pocket, then, was it worth it, anyway? I think without just kind of a clear plan of, what it is that what are your 5-year goals? What are your 10-year goals? Where do you want to be? Like, why real estate? What is real estate going to do for you? Is it a vehicle to get you from A to B? Is it about generational wealth? What is it about it that you're getting into it? And then, really, there's nothing wrong with maybe doing a personality test, a disc test, something along those lines. Figure out what your strengths are, because so many of new investors come into this thinking, oh, raising capital is going to be easy, or I like talking to people, so I'll be good with brokers. Well, it's not that easy to talk to brokers, right? I mean, it's not that easy to raise capital. So figure out what your strengths are, and then really find a way to be able to add value to other people, especially people who are already doing what it is that you want to be doing. Because when you can add value, and we've heard this time and time again, when you can add value to people who are doing what you want to be doing, chances are they're going to bring you into the fold in some way. And that's how you can start to get your feet wet, start to build your portfolio, and then grow from there. Sometimes, we all, I think we all do it, right? There's this mentality, the squirrel, right? Oh, this person's doing that. They're having success. Oh, wait a minute. I should be doing this, and I know I am completely guilty of it. And it wasn't until this past summer, I actually did I was involved in a coaching program. And it really just taught me a lot about alignment. Figure out who you are, Beth, as a person, figure out what you align with. And then from there, create your box of, if you want to be a squirrel and maybe dabble in a couple of different areas within the real estate space, at least know that what you're doing are things that you align with. At one point in time, I thought, oh, maybe I could be a wholesaler. And then I started talking to wholesalers, and I'm like, No, I don't want to make 50 to 100 cold calls a day. That's just not what I want to be doing, right? So you have to know, exactly, what it is, you're getting into. And two, there are so many people out there making promises about how you can make money doing this and you can make money doing that. And, our syndication is truly passive. I mean, there's an argument that could go both ways on that, right? So I think it's important to recognize that this is a long play. It's not a short play. And you have to be in it for the long haul. So my recommendation, if you have a W-2 job, maintain that W-2 job or whatever it is that you're doing. Maybe you have a small business and you're doing real estate on the side. Great. But don't give it up completely. And I have seen people do this. Totally abandon what they're doing. I'm jumping, all into real estate only to find that 6 months later, they've spent thousands and thousands of dollars and haven't, moved the needle forward whatsoever. And they've had to go back and take on a job again. So I would say, we're very blessed that we have our construction company. So it allows me to work on building our future while we still have something that is providing, a roof over our head, food on the table, and whatnot.
Yeah, great. Very well explained. Thank you so much, Beth. So how can our listeners learn more about you and your business?
Sure. So you can email me, Beth, at investingwithbeth.com. You can text me, 513-470-1078. You can go to my website, investingwithbeth.com. Follow me on TikTok, Instagram. My handle is at investingwithbeth. And happy to connect with anybody that wants to learn more. And I'm an open book. I'll share my experiences because I always, just want to make sure that people are doing things for the right reason.
Yes. Thank you so much for coming on today, Beth, and looking forward to connecting with you here in the near future.
Thanks for having me.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.